The S&P 500 just hit 7,600 for the first time in history. And I know exactly what most people are thinking right now. I've missed it. It's too late. The market is too high. But here's what I want to show you in this video. Not only is it not too late, right now is actually one of the best times to understand exactly how to build a $1 million portfolio. Because the same market that just hit 7,600 is the exact same market that will build your wealth if you know what you're doing. By the end of this video, you'll know exactly which accounts to open, what to put in them, how much to invest, and the precise strategy that turns average income into $1 million over time. No get rich quick, no stock picking. Just the boring math that actually works. Before we get into the how, let's talk about why most people never build $1 million portfolio, even though they earn enough money to do it. The average American earns around $60,000 a year. Over a 40-year career, that's $2.4 million in lifetime earnings. Yet the median retirement savings in America is just $87,000. That means most people earn enough to become millionaires and end up with almost nothing. Why? 3 reasons. First, they never start. They wait until they feel ready, until they have more money, until the market feels safer. Ready never comes. Second, they invest in the wrong things. Individual stocks, crypto, hot tips from coworkers. High risk, high fee, low return. Third, they don't understand compound interest. And once you see this math, your entire relationship with money changes forever. Here's the number that changed everything for me. If you invest just $500 a month starting at age 25, at a 10% average market return, by age 65, you'll have $3.2 million. Not from luck, not from a hot stock tip, from $500 a month in time. That same $500 a month starting at age 35, just 10 years later, grows to only $1.1 million. A 10-year delay costs you over $2 million. Time is the most valuable ingredient in wealth building, and you can never get it back. So let's make sure you don't waste another day. Here's exactly how to build your $1 million portfolio from scratch. Step 1, and this is non-negotiable. Before you invest a single dollar, you need a foundation. Open a high-yield savings account and build a 3-month emergency fund. Right now, Marcus, Ally, and SoFi are all paying 4 to 5% interest. Your emergency fund should be earning money while it sits there. Do not skip this step. Without an emergency fund, one bad month forces you to sell your investments at the worst possible time. Once your emergency fund is funded, now we invest. And the order matters enormously. Account number 1, your 401k up to the employer match. If your employer matches your 401k contributions, even partially, that match is a 50 to 100% instant guaranteed return on your money. Nothing in the stock market can compete with that. Contribute at least enough to get every dollar of the match before doing anything else. Account number 2, a Roth IRA. This is the single best investment account available to most Americans. You contribute after-tax dollars, and your money grows completely tax-free, forever. When you retire and withdraw, no taxes. The IRS limit is $7,000 per year in 2026. Max this out every single year if you can. Where to open one? Fidelity, Vanguard, and Charles Schwab are all excellent. Free to open, no minimums at Fidelity and Schwab. Account number 3, back to your 401k. Once your Roth IRA is maxed, go back and increase your 401k contributions toward the annual maximum of $23,500 in 2026. Once your tax-advantaged accounts are maxed, anything additional goes here. Same investments, just without the tax benefits. That's the order. Emergency fund, 401k match, Roth IRA, max 401k, taxable brokerage. Follow this sequence and you will be in the top 5% of investors in America. Now, what do you actually put inside these accounts? This is where most people overcomplicate it completely. They research individual stocks, watch financial news, try to pick winners, and almost universally, they underperform the market. Here's the brutal truth. Over any 15-year period, 92% of actively managed funds underperform a simple index fund. Professional fund managers with teams of analysts and billions of dollars cannot consistently beat the market. What makes you think stock picking will work for you? The answer for almost every investor, especially beginners, is index funds. What is an index fund? It's a single investment that owns a tiny piece of every company in an index. When you buy a total market index fund, you own a piece of Apple, Microsoft, Amazon, Google, and thousands of other companies all at once. When the overall market goes up, you go up. When it goes down, you go down. But historically, the US market has always recovered and reached new highs. Always. The 3 index funds that cover everything you need. Number 1, VTI or FSCAX. Total US stock market. The backbone of any portfolio. This one fund owns over 3,500 US companies. Expense ratio, 0.03%. That means for every $10,000 invested, you pay just $3 per year in fees. Number 2, VXS or FTIHX. Total international stock market. Gives you exposure to companies in Europe, Asia, and emerging markets. Diversification beyond the US. Number 3, BND or FXNAX. Total bond market. Lower return, lower volatility. How much you hold depends on your age and risk tolerance. A simple starting portfolio. 80% VTI, 20% VXS. That's it. 2 funds. Set up automatic monthly contributions. Don't touch it for 30 years. That's the strategy that outperforms 92% of professional fund managers. As you get closer to retirement, gradually shift some percentage into bonds to reduce volatility. A common rule of thumb: your age as a percentage in bonds. At 30 years old, 30% bonds. At 60 years old, 60% bonds. This isn't exciting. It's not supposed to be. Wealth building is boring. The excitement comes when you check your balance in 20 years. Let me show you the math that will completely change how you think about money. This is the part most people never see laid out clearly. Let's say you're 30 years old right now and you invest $400 a month. That's $13 a day, roughly the cost of lunch, at a 10% average annual return, which is the historical average of the S&P 500. By age 40, 10 years in, you'll have invested $48,000 of your own money, and your portfolio will be worth around $81,000. By age 50, you'll have invested $96,000 of your own money, and your portfolio will be worth around $272,000. By age 60, you'll have invested $144,000 of your own money, and your portfolio will be worth around $811,000. You invested $168,000 of your own money and ended up with over $1 million. The other $848,000 came from compound interest, from your money making money, from doing absolutely nothing. That's the magic of compound interest. Einstein reportedly called it the 8th wonder of the world, and it works exactly the same way whether the market is at 7,600 or 3,000. Time and consistency are the only ingredients that matter, and it works exactly the same way whether the market is at 7,600 or 3,000. Time and consistency are the only ingredients that matter. Now here's what happens if you wait just 5 years, starting at 35 instead of 30 with the same $400 a month. By age 65, you'll have $601,000. You invested $144,000 of your own money, but ended up with $400,000 less, just because you waited 5 years to start. Start today, not next month, not when you feel ready, today. Now let's talk about the 5 mistakes that derail most investors. Because knowing what not to do is just as important as knowing what to do. Mistake 1, trying to time the market. Waiting for the perfect moment to invest. Waiting for a crash. Waiting for the market to feel safer. Research consistently shows that missing just the 10 best days in the market over a 20-year period cuts your returns in half. You cannot predict those 10 days. Stay invested. Mistake 2, panic selling during downturns. The market drops 20 to 30% every few years. This is normal. It is not a crisis. It is a sale. The investors who sell during downturns lock in their losses and miss the recovery. The investors who keep buying during downturns, or at minimum do nothing, end up significantly wealthier. The S&P 500 has recovered from every single correction in history. Every single one. Mistake 3. Paying high investment fees. The average actively managed mutual fund charges 1% or more per year. On a $500,000 portfolio, that's $5,000 per year in fees. Over 30 years with compound interest, that fee difference costs you over $400,000 in lost growth. Index funds charging 0.03% are not just cheaper. They statistically outperform the expensive funds they're competing with. Mistake 4. Not investing in tax-advantaged accounts first. Paying taxes on investment gains every year when a Roth IRA lets those same gains compound completely. Tax-free is one of the most expensive financial mistakes people make. Always max your tax-advantaged accounts before investing in a taxable brokerage. Mistake 5. Stopping contributions when life gets hard. Job loss, unexpected expenses, economic uncertainty. These are exactly when most people stop investing, and exactly when continuing to invest matters most. Even $50 a month during hard times keeps the habit alive and keeps compound interest working. Never stop completely. Okay, let's turn everything we've covered into a concrete action plan for your first 30 days. Week 1. Open your accounts. Go to Fidelity.com or Schwab.com today. Open a Roth IRA. It takes about 10 minutes. Link your bank account. If your employer offers a 401k and you're not contributing enough to get the full match, log into your HR portal this week and fix that. These 2 steps alone put you ahead of the majority of Americans. Week 2. Build your emergency fund. Open a high-yield savings account at Marcus, Ally, or SoFi. Set a target, 3 months of expenses. Calculate that number. Set up an automatic transfer from your checking account every payday until you hit it. This is your financial safety net that protects all your other investments. Week 3. Make your first investment. Log into your Roth IRA. Search for VTI or FS-CAX. Buy whatever amount you can, even $50. The dollar amount matters far less than building the habit and the account. You can increase contributions over time, but you cannot go back in time to start earlier. Week 4. Automate everything. Set up automatic monthly contributions to your Roth IRA. Set a date, ideally the day after your paycheck hits. Choose an amount you won't miss, but that moves the needle. Even $200 a month. Automation removes willpower from the equation. You can't forget to invest if it happens automatically. Then, do nothing. Check your portfolio once a quarter maximum. Rebalance once a year if needed. Let compound interest do the work. The people who check their portfolios every day are not better investors. They're just more anxious ones. Set it and let it grow. The S&P 500 at 7,600 is not a reason to wait. It's a reason to start. Every day you delay is a day of compound interest you can never get back. The market will go higher. It will also go lower, and then it will go higher again. That's how it has always worked, and that's how it will keep working. Your job is simple. Start, stay consistent, and don't panic. All of the books and resources I mentioned in this video are linked in the description below. If you found this helpful, please subscribe to WealthWired. I post weekly videos on personal finance, online business, and AI tools to help you build wealth faster. And if you have a specific money question you want me to cover, drop it in the comments right now. I read every single one and it helps me know exactly what to make next. I'll see you in the next one.